Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities space. My name is Jesse Day. Before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And today's episode is sponsored by ARC Silver Gold Osmium. They offer personal service and often the lowest price, period, with no minimum purchase for silver, gold, platinum, or osmium. ARC SGO is available to discuss precious metals by email, phone, or in person at their retail location in Jackson, Wyoming, and they are committed to providing the best prices out there and making sure you get the best value and lowest premiums on their wide selection of products. Go to arcsgo.com and contact the owner, Ian Everard, at 307-264-9441 or Ian at arcsgo.com, and make sure to tell him that Commodity Culture sent you. And today's guest is a contrarian macro strategist with 50 years of experience on Wall Street and the chief macro strategist at Contrarian Macro Advisors. We're going to be discussing areas of the commodities sector that he's both bullish and bearish on, as well as getting his thoughts on the broad market. David Hunter, it's great to have you on the show.
Hi, Jesse. Thanks for having me on.
We have to start here by discussing gold, trading at all-time highs as we speak, continuing to rise higher. Obviously, people very excited about that. I wanted you to give us your thoughts on gold's rise here and how you see the gold market performing for the rest of the year and beyond.
Yeah, I think gold looks great here. I think it's about to break out. That's obviously made a new closing high this week. And I see the dollar rolling over, interest rates after a backup beginning to move down again. And I think they'll go to probably go towards 3% before they correct again. So you've got the dollar and interest rates working in the right direction for gold. And I think that's the signal that gold's about to break out of this trading range it's been in for quite some time. And my forecast is 3,000. I've got a forecast of a global bust starting probably later this year into next year. And I just called a pre-bust forecast of 3,000 on gold. And to me, that's a conservative estimate. I think if anything, it's going to exceed that.
So do you think in the case of a global bust that we will see gold fall along with the rest of the market, at least initially, before potentially climbing back up? Or how do you see that scenario playing out for gold?
Yeah, global bust is in my definition of global bust is something that's worse than our typical recession, but not drawn out like a depression. So it might feel like a depression, but it'll probably be contained in a 12 to 18 month time frame with a lot of financial a big financial piece to it. So sort of like 2008-9, but probably worse. So in that kind of a scenario, I think pretty much all assets other than, government guaranteed treasuries and the US dollar, which will get a flight to safety bid at that time. Other than those things, I think most other assets are going to get hit. So gold will get hit, probably not as hard as the equity markets, certainly not as hard as the equity markets, but I think could get hit pretty hard, but it's from that higher level.
And you mentioned dollar weakness. What are the signs you're seeing right now that lead you to believe the dollar could be headed lower?
Yeah, it's mostly, the charts, the technicals suggest that it's rolling over. And I've expected that. We had that big move down a couple of years ago from 115 down below 100 on DXY. And, we've spent many months here kind of consolidating that. It started to go again, and then it had another counter trend rally. I think that counter trend rally has pretty much run its course, and it just looks now like the dollar's getting heavy. And once it gets going, I suspect we'll see it down to the mid 90s pretty quickly. And then from there, down to 90. And from there, I have a forecast again, probably a 2024 forecast of 80. So, from 103 and change now, down to 80 is a big drop, and that will certainly help gold and silver.
Are there any currencies outside of the US dollar that you see performing well up ahead and under this scenario of a global bust, or will it kind of be a case of them all sinking together?
Well, let's put it this way. Keep in mind the dollar weakness is pre-bust. So you've got a big move down in the dollar coming here. So pretty much all the currencies versus the dollar will be up, including the yen. The euro looks good, the British pound looks good. I think Canadian and Aussie dollars will trade up pretty aggressively if you've got to move down to 80 in the dollar. So it's a two-step process. I don't want people confused. You've got this big down, but then you've got a big up during the bust. And so during the bust, yeah, it's going to be the reverse of what we're going to see here. The dollar could go back to 120 or higher. And virtually all the other currencies I mentioned will be going down pretty hard. So it'll be a flight to safety. As much as the dollar has some problems ahead, and we all know what everybody's worried about, in terms of the Russia and the BRICS and China, etc. Saudi Arabia maybe moving away from dollar, etc. All of that, I think, is going to weigh on the dollar, but not during the bust. I think we still become the place of refuge if things start turning pretty rough.
Well, I would like to get your long-term forecast on this trend of de-dollarization that seems to be occurring. Different people place different levels of emphasis on it. Some believe it's kind of not something that's even that important, and the US dollar is going to be around in a significant way for a long time to come. I'm wondering what your thoughts are there with the BRICS nations, Saudi Arabia, as you mentioned, divesting themselves of the dollar when it comes to international trade. Is this a significant event in your view? How long do you think it's going to take to play out before it has a major impact? And is this ultimately a tailwind for gold?
Yeah, I certainly think the dollar will come under pressure in the second half of this decade. You get through this global bust, and I think that will be the peak in the dollar, and it'll be all downhill from there. How fast is hard to know because this is going to be a global bust, and as we know, when we catch cold, the rest of the world catches pneumonia, and this is going to be us catching pneumonia. So the rest of the world's going to be in really rough shape. I just don't see where China, Russia, or anybody else is in a position to replace the dollar as a trade currency. So they can talk about it all they want and try to plot against the dollar all they want. I think it's going to be a long process. So certainly the next 5 years, the dollar is still going to be, the king of the hill in terms of trading, in terms of trade. Um, as we get to later in the decade, I'm forecasting a huge inflation cycle as a result of um, what the Fed has to do, and also central banks, frankly, have to do during the bust to counter the bust and pull us out of it. It'll be a free falling financial system during the bust, and so they're going to be printing and printing and printing. Probably my estimate is be something 4 or 5 times what we saw in 2020, 21. So I mean, 20 trillion coming out of the Fed is my estimate. Could be a little less or more, but that kind of number is going to trigger, and all central banks doing something similar proportionally. That's going to trigger a huge inflation cycle that will far surpass, I think, the early 80s and certainly what we've seen of late. And so as you get to the end of the decade, you could be looking at, high double-digit interest rates, high double-digit inflation, and obviously a budget that can't be serviced, or we're going to really struggle. Again, it's a worldwide problem, but focused on the U.S., I think we're going to have a hard time making the case that the dollar is something sound and where people want to be. So, later in this decade, I think the dollar is going to be under a lot of pressure. You could see it that DXY could be under 50 by the end of the decade, and then keep going from there. So I understand the concerns about de-dollarization. I understand all of that. I just think those that are in that camp and think it's something that's coming very quickly. I think it's quick in terms of history, yes, but quick not in the next year or two.
Yeah, that's an important distinction. I do want to dive into your theory of this global bust in a moment, but before we do, I want to touch on silver here because silver nowhere near its all-time highs. To call it a disappointment for many is kind of an understatement. It has had quite a lackluster performance since the last time it was at its all-time high around 2011. I'm wondering what your thoughts are on silver. Do you view it as a similar asset to gold at this point? Has it become more of an industrial metal in your view? What are your thoughts on silver and how it could potentially perform up ahead?
I think silver still is poor man's gold. So it does have some of the characteristics of gold, but it also does have more of an industrial, you know, piece to it. So, yeah, it's been, I think it's an understatement to say it's been a disappointment. It's certainly been kind of the asset that has just not performed for a long time, and has disappointed lots of us, including me, over a long period of time. I do think you have to kind of step back though and realize, because I think a lot of the bears on silver, or those that were bullish and got really beat up by it, they they think it's been, since 2011 nothing's happened. Well, you had a pretty good run in certainly the silver miners and in silver in 2016. You had a very fast big run coming out of the pandemic. March 2020 ran to August 2020 with a really big run there. And then from there, it's been a really difficult slog. So it's been consolidating. A lot of the problem, I think, has been the dollar. And it just, silver gets hit a lot harder than gold when it's, in that period of strong dollar. So I think it's all set up now, where you've come down to some very important support lines, technically, where fundamentally silver is, because of EV, et cetera, silver is going to be in demand. There's, it's a metal that's going to be in short supply. And it does have the characteristics of when gold runs to 3,000, it's going to get a bid. So I have a pretty aggressive forecast pre-bust again, of $60, which may seem unbelievable given what we've dealt with this last decade, but $60 between now and the bust. And then, and I've said if it breaks above 60, you could run to 75 very quickly. So 60 is my target, but 75 wouldn't surprise me. And then it will get hit harder than gold in the bust. So what that means, if we, you don't know whether we're going to 60 or 75 or 50 or whatever. If I'm right, it goes to 60 plus. You could see it back here certainly, in the bust. And given it's, how easily it can move down, you might even see it down into the teens. So, I do think people have to be aware it's not a straight line post bust because of what I see coming as a huge commodity cycle. Post bust, I think silver could get to $500, gold could get to 20,000. But people just have to understand there's, it's not a straight line. There's this bust in between. As I say, it's like standing on the south rim of the Grand Canyon and looking across to the north rim and thinking you can walk straight across. And obviously you can't. We're going to have that big canyon in between. So, those that think you want to own silver or gold and just hold it right on through, particularly silver, understand what you're doing if you do that, because it's going to be painful.
Interesting. I would like to now get your thesis on this global bust you see coming. What are the main catalysts that are driving it? How can investors protect themselves from it as well? Are there any asset categories that you currently see that can provide some shelter from the storm that you see coming?
First, my reasoning for a global bust, and I've been forecasting this or talking about this for a while, as what would come after we had this so-called melt up in the market. My reason for forecasting global bust, which I view as kind of 2008-9, and what would have come then if we hadn't kind of stopped from going over the cliff when the commercial paper market froze and GE almost went under, et cetera. The government reacted just in time and saved us from a bust then. So this is kind of that next step, because I think we probably won't act fast enough and because we had a lot of leverage in 2008-9, we now have leverage on steroids. I mean, we've got 320 trillion in global debt. We've got quadrillions in notional value of derivatives, which is leverage on the markets. Debt is leverage on the financial system or on the economy. Derivatives is leverage on the markets. So you put those two pieces of leverage together at levels we've never been at before by a long shot. And leverage can enhance on the way up, but it can really destroy you on the way down. So that's probably the reason why I think what would have been a normal downturn is going to turn into something much worse. Um, you add to that all the fragility that comes as a result of the pandemic. We've statistically come out of the pandemic, but there's still a lot of imbalances and things that resulted from that pandemic. And so I think they operate underneath the surface and we can kind of forget about them because everybody's focused on what's the GDP number or what's some economic data number. But below the surface, small businesses are certainly not in the same place they were, 5 years ago, et cetera. So, and we've got, a labor situation that's very different than would have been if not for the pandemic, et cetera. So I think it's leverage plus the fragility, plus what I think will prove to be a big central bank policy error, because it is global, so it's not just the Fed. They're all fighting what I think is the last war, which is inflation. They got so surprised by the breakout in inflation after decades of disinflation that I think they're going too far in terms of wanting to see the results of everything they do. There's maybe a 9-month lag to policy, 9-month or year lag to policy versus the economy. There's probably a 2-year lag to inflation. So if you think about what the Fed is doing in terms of saying, and Powell speaking today, obviously to Congress, will probably repeat it. They want to see more done to inflation. They want to see the results of their policy before they move. If you've got that kind of a long lag, you've already gone too far on the tight side, and by the time you realize you went too far, you're in a bust. So it'll start with a recession, but then I think because of the leverage, move into a bust. And timing is tough. It's something we haven't had a bust in the post World War II era, so I can't pretend to know what month it starts or what quarter it starts, but I think it could begin before the end of this year, may not, and then I think 2025 is probably the bulk of it. But so that's the bust I am forecasting. As to how you deal with that, along with the bust, I'm expecting an 80% bear market in the U.S. equity indexes. So again, we haven't seen that in the post World War II era. We were down 65 or 6% in 2008-9, I think, and we haven't seen anything like 80%, except in 1929 to 32, we were down almost 90%. So I mean, that's a big deal. People are going to need to protect themselves, and we're in a melt up before we get there. So, people have fought this market. I've been a lonely bull from 3,500 on up, and you're now seeing some capitulation. People starting to come in and be more bullish and raise their targets on the S&P to 54, 5,500. I'm at 7,000 on the S&P, and I think that could happen maybe by mid-year, maybe by summer. And it's a melt up because I think we've gone since last October pretty vertical. It's just going to steepen right into the top, so parabolic. But then from there, whatever the top is, whether it's 7,000, it could exceed that. From there, you could drop 80%. So it's going to be important for people to fight their own emotions, because at the top, I can promise you, everybody, including institutional money managers, including other strategists, they're all going to be all in. It's psychology. At the top, everybody's bullish. there's going to be a reason why we're at 7,000. It's going to be compelling that it looks like the Fed's done its job and they're going to ease and the cycle's just beginning, all of that. And it's going to be very hard to fight that, but you're going to want to fight that. Again, I'm not saying pinpoint 7,000. I don't know whether I'll be right about that number or it'll be higher. I think it's going to be up near there. But on the other side of that, if you stay stay fully invested and do the buy and hold, etc., you can have a steep ride down. And so protecting yourself is going to be important. The areas that I think can help people protect their assets in bust are treasuries. I'm forecasting that the 10-year can get down to zero in the bust for two reasons. One, we're going to have ultimately this will be a deflationary bust. It won't start out in deflation, but by the time we get through the bust, it'll be deflation. And number two, central banks, the Fed's going to be printing money like crazy. How do you print money? You basically buy from the dealers. QE is basically buying the treasury securities from the dealers, everything from T-bills on out to 30-year bond. And so there's going to be, they'll have an insatiable demand for any treasury that's out there. There'll be plenty of new treasury supply to feed them as well, because the monetary expansion will be matched by fiscal expansion. So I'm not endorsing this. I'm not saying this will end well. I'm saying this is inevitable. When they're faced with a free falling financial system, they meaning all the central banks, they can't sit back and say, "Oh, we can't do this again." They're going to say, "We got to do whatever we have to do to save the system." So you will see this. And again, I can be off in magnitude, but I think it's pretty inevitable. This is where we're headed. So treasuries will be one place where you can get where I think you will see appreciation during the bust, and certainly will protect your capital. I'm not worried about the government defaulting on those treasuries in this cycle. So, because of the printing press. And so that's probably the one area where you can protect yourself. And then again, for some people, the US dollar, if I'm right, that gets a flight to safety bid. And it goes from 80 to, possibly 120. Those will be the two areas that will be bucking the downward trend.
And you mentioned that you see a commodities super cycle after this bust. Could you walk us through your thesis there?
Yeah, it's pretty simple. It's if you get anything close to the numbers I'm talking about in terms of what it's going to take to bail the system out, 2008-9, our banks were very leveraged and in rough shape, and we had the subprime issue in it, et cetera. Our banks are in much better shape this time around, but the rest of the world is not. I mean, European banks are in rougher shape. Canada kind of didn't, they were in great shape going into the 2008-9 situation. They didn't learn the lesson. They're now leveraged up and have a lot of real estate issues over there. So Australia's got, decades, and I mean many decade long real estate cycle has taken their real estate through the roof, and their banks are heavily involved. So there's potential elsewhere. Counterparty risk means even if our banks are in better shape than 2008-9, they're not immune from this. They're going to get hit hard too. So it's going to be what I call a free falling financial system, and it's going to take a lot of money to stop that. And their first effort isn't going to be successful. It's going to keep falling. Their second effort won't probably do the trick either. So it'll take many efforts to figure out how much money really it takes to stabilize the system and get it to turn around. By the time they get done, that money will be way beyond anything we've ever seen before, and it will trigger an inflation cycle with a lag. I'm not saying it's going to come right away on top of the bust. You will see probably a period of a year or two where inflation comes first. We're coming out of deflation, so it's going to take a while to get to positive, maybe 6 months. So, by the end of 2025, you're probably back in inflation, low inflation. By the end of 2026, you're probably in, mid to high single digits. By 27 and 8, you're in double digits. And by 29-30, you could be at 25% inflation. So, I mean, you just can't put that kind of money out there. And remember, we've had decades of underinvesting in commodities. Obviously, it's getting harder to find commodities, whether it be, minerals, metals, oil, gas, whatever. It's not as easy to find those sources. It takes more capital to find them, and with suppressed prices, the commodity companies didn't invest there. So it takes years for a new mine to be developed, oil fields, etc. This demand's going to come, probably by 27-8, demand's going to be pretty strong, if not before. They're just not going to be the supply, even if you start developing new sources. There's just not going to be supply. And then on top of that, we got all this politicalization of energy. So alternative energy is just there's no way it can keep up with what's coming. And of course, we have onshoring, reshoring, nearshoring, all these new capital plants, semiconductors, et cetera, auto company, whatever. You're going to see a lot of industrial building, even steel mills and things, because we made a mistake. For decades, we farmed out, we shipped overseas a lot of our plant and equipment, we don't have onshore the kind of sources of supply that we need in many industries, including a lot of industrial, but also pharmaceuticals, et cetera. You can see a lot of that coming back over the next decade, and it demands a lot of commodities for that. So the demand's going to be going through the roof, and at the same time, all the money is going to be creating, inflation, and you've got a shortage of supply, and you put it all together, and you can get some crazy price moves. So I'm calling for $500 oil by the end of the decade. I think, as I said, 20,000 gold, $500 silver. You could even, I think, I don't have numbers for copper or any, iron ore, et cetera, but you can just assume they're all going to go vertical. And so, at the same time, what does that say about the consumer? He's going to be in trouble. He's going to be hit by, the bust. The wealth is going to get hit hard in the bust. And then he's going to be faced with this huge inflation cycle beyond. And I don't think we've been accustomed to decades here, really since the 80s, of a consumer-driven disinflationary type environment. It's going to be the exact opposite. It's going to be back to the 70s and early 80s again, where it's industrial-driven, inflation-driven, commodity-driven cycle.
Very interesting. You mentioned $500 oil there. I know that I've heard you in interviews recently say you're bearish on the energy space in the near term, but you believe after this bust, we're going to see you at that point, you'll turn bullish if we look out 5-10 years. Is that correct?
I think we could see oil down as low as 30 in the bust. And it's, where is it now, $80 or thereabouts. So that's a big hit. But just because of a global decline in demand, I think you could get it down as low as 30. And then as we come out of the bust and as we have a recovery, energy's going to go to short supply very quickly because of, partly because of policy that's pushing away from fossil fuels, and partly because as I said before, the oil fields take a while to develop, and we've really underinvested for quite some time here. So again, by mid, let's say 26, 7, 8, oil could be pushing up pretty fast, and I would say it'll begin probably in 25. Markets anticipate. So you will begin coming, if you get down to 30, let's say next year, by the end of next year, you could easily be back up towards these levels, or certainly 50, 60 on the way to these levels, and then move up from there pretty fast.
Do you have any thoughts on uranium? Some are pointing to an idea that uranium is more recession resistant than a lot of other commodities because there are so many reactors being built out, because there is such a large supply shortfall, and these reactors need the fuel no matter what, that maybe uranium and related equities wouldn't get hit as much as other commodities in a downturn. I wonder if you have any thoughts there.
Yeah, I really don't. I don't follow it closely enough to talk about it short term. Certainly, I think it will be part of the commodity run second half of the decade. How it holds up in the bust, I don't have an opinion.
Okay, well, I want to know if you see any areas of the world outside of the US that will be more resilient to a global bust, either when it's happening or afterwards. Are there any emerging markets that you're currently looking at that you see any potential value in? What are your thoughts there?
My focus is U.S. I would presume, post bust, India's, probably going to pick up some of, we're certainly moving away from China. I don't think that's going to stop. So somewhere you have to see that slack picked up, and I would think probably India is the most likely candidate. Um, and I do think resource rich countries are going to do well. So including Canada and Australia, but also Africa, et cetera. I think you will see, you can't help if you have the kind of moves in commodity prices that I'm talking, you can't help but see those countries benefit. So that would be where I would say post bust, you see things, moving. I'm not sure, as I say, the U.S. from a equity standpoint, no doubt, commodity equities will do well. Commodity producers and commodity stocks will do well. Looking at the indexes, people have to understand what we had for the last 30, 40 years, where interest rates trended down, and that meant P multiples trended up. So in 1982, and I was there then, we had single digit PE multiple, market multiple, and it's moved to 2025. You're going to have the reverse happen in the post bust because inflation and interest rates are going to be moving up sharply. PE multiples are going to be compressing. And that means index investing, which has been so successful for the last few decades, is going to be probably something that hurts you going forward. So you're going to have to be more of an active investor, or at least understand which parts of the market, meaning the easy places is commodities, but also probably industrials. You're going to have to be a little more focused and concentrated.
Yeah, I've actually heard that sentiment echoed by a few other guests on the show as well. It's funny because it seems like a lot of people have taken it as gospel that you just dollar cost average into an index fund. I'm actually reading A Random Walk Down Wall Street right now, and that's kind of the whole thesis of the book is fundamental analysis doesn't work, technical analysis doesn't work, just buy the market, hold on to it. It's proven to work, but sometimes things are different, and it does seem like the market environment is shifting to make it so people have to be more active in a way and understand what they're doing, as opposed to just buying the S&P and sitting on the sidelines and dreaming about their retirement. So
And
I wonder, yeah.
when you have a long cycle, basically we've had a secular bull market from 1982 until now. When that cycle is driven by something like disinflation that's been in place for most of that 40 years, it looks like it's permanent, right? In people's minds, something that long is basically something that doesn't change. But cycles come and go, and even long cycles come and go. So people have to understand it really does. It is important to understand what got us here, why indexes did so well, and why they won't going forward.
And are there any asset categories, whether in the commodity space, outside the commodity space, that you think will perform well post bust, that we haven't discussed already that you'd like to touch on?
I would just say, you know, precious metals, which have been difficult for investors for a long time, are likely to be the last man standing if you follow through the logic of the next decade, because things will drop off as you go along. At some point, interest rates are going to move up and they're going to even and hit the economy, and so the more industrial driven demand, commodities will fall off before the precious metals, right? So the precious metals will probably be the last of the commodities, if you want to call them a commodity, to drop off. And I'm not saying those will drop off quickly because they'll go almost to the end of the decade. Energy will be up there probably just before the precious metals in terms of when they drop off, but it'll be a process where I think precious metals will be the last ones to finally reach their peak. On a reverse side, again, indexes are one I wanted to highlight. The other one you really need to understand is we've been in a 4 decade long secular bull market in bonds. There, I would say, the vast majority of pundits think that's ended. That this move up to 5% plus on the 10 and 30 year, and on short rates, that was the end of the secular move in rates, that we won't get back down to the levels we saw in 2020 again. I'm pretty unique, I think, out there, certainly one of the few that believes we will see lower lows in rates one more time because of the bust. So you'll see a 0% 10-year, you'll see a quarter or a half on the 30-year, you'll see short rates go negative. That will be the last hurrah in the bond market. And then from there, if you follow my logic on inflation and interest rates, bonds will be one of the worst assets to own post bust. If rates go from zero on a 10-year to something like 17 or 18%, and short rates go from negative rates to maybe 20, 25%, they were 20, T bills were 21% in 1980 or 81 back then. So if rates exceed that, and because inflation is going to exceed that period, let's say 25, 0 to 25, or let's take the long bond. If you're owning a long bond and it tops out at let's say 0.5%, and then runs up to 18% or 17%, you're hit really hard. I mean, that's about as bad an investment as you can have in that environment. So people need to understand what worked for the last 30 or 40 years is going to be the exact opposite in the next 10.
Well, David, thank you so much for joining us today. It's been an extremely enlightening conversation. For those who want to learn more, could you tell us about Contrarian Macro Advisors, what it is you do there, where people can find it, and anywhere else you'd like to direct people online, feel free as well.
Like you said, I've been doing this 50 years, and now the Contrarian Macro Advisors is basically my investment letter. I put out a quarterly macro letter. It's very contrarian. I am a contrarian, and so just like in the last, really since October 2022, when most pundits were and most strategists were talking about lower, I was bullish at 3,500 and have remained bullish all the way up, and was the author of the melt up call that now you hear more people talking about because the market's up. But that's what my letter basically fills in the details on that forecast, on the whole commodity thing we talked about, et cetera. So I put it out quarterly. People want to know why I don't put out monthly or whatever. My views don't change that often. Just it's an update every quarter, but it's I'm a big picture macro guy. I think I do as well as anybody in the world. I've been doing it for 50 years. And then you combine my macro skills with that real contrarian bent. And I've been that way for my whole career too. It's, I think, a fairly unique letter. I tend to be early. I tend to see things before others, and then they ultimately get there. And while I'm contrary and at the two extremes, at the bottom and the top of a market, I'm going to be almost alone, and people are going to think I'm nuts. They thought I was crazy back at 3,500 or even 4,000, talking about 6 or 7,000 on the S&P. Now they don't, now they at least see the possibility. And at the top, it's going to be the same thing. I'm going to be very bearish when everybody's bullish. So that's the nature of a contrarian, and that's what my letter does. It is by subscription, so there is a cost to it. If people are interested in it, I don't have a website. They can direct message me on Twitter, and I will provide details. I'm on Twitter pretty much every day. My handle is at Dave H Contrarian, not David, but at Dave H Contrarian. And I most of the time I'm replying to people. I used to initiate more tweets, but it's my communication method. Is the questions I get asked, I communicate to that person, but I'm really communicating to others too. And I find it's a kind of best way to get my message out.
Great. Well, I'll put a link to your Twitter in the description below. And thank you once again, David, for coming on the show and sharing all your knowledge with the audience.
Yeah, thanks, Jesse. My pleasure.
And thank you for joining us today. As a reminder, this episode is sponsored by ARK Silver Gold Osmium. Contact them at 307-264-9441 or by email at ian@arksgo.com for the best prices out there, and make sure to tell them Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.